You all know the story of Lehman Brothers. You've all seen The Big Short. As they say in that movie, you at least have the snippet of information that you tell your friends and colleagues about what happened with Lehman Brothers. Well, believe it or not, a very similar situation just occurred today. Another massive bank has collapsed and gone under, and now its funds are being held by the FDIC, and we need to talk about it. Make sure you like the video, make sure you subscribe to the channel, and let's jump into the information. Silicon Valley Bank fails after run by venture capital customers. If there is one enduring axiom in banking, it is this: don't run out of money. Great. Good start, New York Times. Silicon Valley Bank, a lender to some of the biggest names in the technology world, did just that on Friday, becoming the largest bank to fail since the '08 financial crisis. The move put nearly $175 billion in customer deposits, including money from some of the biggest names in the world, under the control of the FDIC. Silicon Valley Bank is a bank for venture capitalists to invest in startups, or rather, should I say, the bank itself invests venture capitalist money in the startups. And they failed. If we continue down this article, I want to jump down to the part where it talks about failing. Silicon Valley's bank spiral accelerated with its incredible speed this week, but its troubles have been brewing for more than a year. Let me skip ahead. Here, flush with cash from high-flying startups, it bought huge amounts of bonds more than a year ago. So they had been given so much money from these startups that were being invested in. The bank was being given so much money from venture capitalists to invest in these startups that they had so much extra money on hand that they, and you all, I'm sure, know this, banks don't just keep the money around in the bank, right? When you put your money in the bank, they use that and they go invest. Now, they do very low risk investing, but that's how banks make money. You put your money in a bank, they invest it. So it put all this money that it was getting from these venture capitalists into huge amounts of bonds more than a year ago, just before the Federal Reserve began to raise interest rates. Like its peers, Silicon Valley Bank kept just a fraction of the deposits on hand. As I just explained, invested the rest. Yes, that's how banks make money. In particular, the bank put customer deposits into long-dated treasury bonds and mortgage bonds while interest rates were low, promised modest, steady returns. That had worked well for years. The bank's deposits doubled to $102 billion. 1 year later, it was $189 billion. They were doing really well. But when the Federal Reserve began raising interest rates last year, these holdings became less attractive because newer government bonds paid more in interest. Of course, the shorter bonds pay more, so they become more attractive. That might not have mattered so long as the bank's clients didn't ask for their money back. Here comes the problem. But at the same time as interest rates were rising, the environment for startup funding dried up. So remember, all their money comes from startup investments, and they were getting a ton. I mean, just look around the world. I'm sure you all can name multiple examples of startups that were started while interest rates were at all-time lows, because getting loans was very easy, or at least not. Loans were very cheap. So everybody and their mother was loaning money and starting businesses. There were startups everywhere. There were venture capitalist money everywhere flowing into this bank. But as interest rates rise, now not only do the longer term bonds that they hold go down in value, that's fine. The bank hasn't invested the money. Investments go up and down just like anything else. It doesn't really matter, except that they now don't have enough money to cover a run on the bank. And a run on the bank is when all the clients of that bank come and try to take their money out at once, or at least at a very close time together. And that is what happened as interest rates rise. As interest rates rise, startups begin slowing way down. Getting loans is way harder. It's not worth taking a loan right now. Interest rates are flying. No one's taking loans to start businesses right now. No one. Most people aren't taking loans to start businesses right now. So the venture capitalists are coming to this and they're ready to take their money out of this bank. The startup business isn't doing well. They don't want to be invested in them anymore. Venture capitalists want their money back. At the same token, the bonds that the Silicon Valley Bank was invested in are going down. So they don't have the money on hand. If we keep reading, Silicon Valley Bank had to sell off off some of its investment at exactly the wrong time. So the bonds that they own are down in value, and Silicon Valley is having to sell them anyway in order to raise the capital to pay back its customers. In its surprise disclosure on Wednesday, the bank admitted it had lost nearly $2 billion when it was all but forced to sell some of its holdings. The upheaval raised uncomfortable parallels to the '08 financial crisis, sure. And then that's the end of the article. There was something else I wanted to read in here, though, about why it failed. Oh, here. Silicon Valley Bank advertised itself as a partner for the innovation economy. It was being shaken by decidedly old-fashioned decisions. To compete with bigger names, it had long boasted of looser lending standards for fledgling companies and offered to pay higher interest rates on deposits than its larger rivals. I told you all you all had seen the movie The Big Short. If you haven't, go watch that movie. First things first, if you care about the stock market, go watch The Big Short. What does this sound like to you? This sounds like junk bonds, right? I mean, they're essentially investing in riskier and riskier startups in order to raise more and more capital. And when there were startups on top of startups on top of startups, that was fine. It worked. All of a sudden, there's not as many startups. VCs want their money back, and the bonds they were invested in were down in value, causing them to run out of money. Now, the FDIC has the money. There was somewhere in here as well. The FDIC created a new bank. This is interesting, too. The FDIC created a new bank, the National Bank of Santa Clara, to hold the deposits and other assets of the failed one. The regulator said in a news release that the new entity would be operating by Monday and that checks issued by the old bank would continue to clear. But for customers with deposits totaling more than $250,000, remember, FDIC ensures that up to $250,000 in the bank. So if you had $250,000 in the Silicon Valley Bank, you're going to get all that money back. Your money is federally insured through FDIC insured banks, which Silicon Valley was. But if you have more than that, customers with accounts that surpass that amount, the maximum covered by the FDIC, as I explained, would be given certificates for their uninsured funds, meaning they would be among the first in line to be paid back, though potentially only partially and maybe not at all. They're not guaranteed that money back. They're just first in line. So anyone over $250,000, they're now hoping they can get whatever pennies on the dollar of that money back from the FDIC. If we go ahead and look at the stock today, or let's zoom out even a little bit further. Let's go to the daily. Not that long ago, remember, this was COVID, all-time low interest rates, startups were flying, venture capitalists were pouring money into this bank. It flew, right? It was a $140 stock during lockdown, post-COVID, went to a $763 stock. It since dropped. It is now now it's delisted. Well, it's going to be delisted, I would assume, from here. Someone might correct me on that, but I would assume if the bank is shut down, it's going to be delisted. But just in the last couple of days, in the last 2 days, it dropped from a $270 stock to a $33 stock, and this morning was halted on a T1 NASDAQ halt for news. That news ended up being that federal regulators were shutting down the bank. SIVB is in a lot of trouble. And if we go ahead and look at other similar bank stocks as well, Western Alliance down 42% today. Signature Bank down 24% today, and it was way worse this morning. FRC down 21.5%, was way worse this morning. Zion Bank Corp's down. It's actually only down 5%. So you're starting to see a big fear, right? This is going to create more than just Silicon Valley Bank being shut down. This is creating big ripple effects in other banks, especially banks that are reliant on venture capitalist money and startups. Those are going to be the banks that are getting hit the hardest. If we take one more click here, actually very interestingly, JP Morgan, the biggest bank in the country, is actually up 1.2% today. If you would like to explain that one to me, let me know in the comment section down below. JP Morgan's obviously a whole different beast than these stocks are, though, but it's very interesting still to see this one up. But that's it. Silicon Valley Bank files after run by venture capitalist customers. It is the largest bank to fail since the '08 financial crisis. You need to know this is going on. You need to pay attention to the ripples it's going to have across the stock market. Make sure you like the video if you enjoyed it. Make sure you're subscribed. I'll catch you all in the next one.